This is Mayor Valensky with the Driving Markets podcast on August the 7th, your weekly podcast. Let's have a look at what's happening in financial markets. So the main topic at the moment is there going to be a market crash? There are some analysts on Wall Street that are deeming or saying categorically there is going to be a market crash of around about 40 to 50% down to the 1929 grade crash levels. Is that going to happen? Well, I personally can't see that happening at the moment, but let's delve into some of those details and see if really there's any substance to those particular claims. So the main claim that they have is that the markets or stock markets and assets, that stocks and shares are overvalued. That is the main claim that they have. Massive overvaluation, quoting the dot-com crash of 2000 and obviously quoting the 2008 banking crisis. So shares and stocks and shares are definitely overvalued. They're at the top of the range, all-time highs. Interestingly enough, that when Trump came in, markets moved up and then completely were dumped. I was going to say crashed, but let's say dumped between January and April on the back of the trade war and the tariffs, and all of the media and obviously all of those who are anti-Trump rode on the bandwagon and said, you see, Trump has destroyed financial markets, stock markets at all-time lows, etc., etc. And that all changed after April when the tariffs were delayed by 90 days. Essentially, August the 7th, which is today, is when those tariffs should be applied to all of the partner companies and trading countries that are working with the US. Big test. Now, what happened was that sent up bond yields super high and bond prices down. Bond yields have stayed high. They haven't actually come down that much, but they seem to be have sort of settled into a tight range. And that is going to cause a problem for Donald Trump and the administration to issue more debt at these high rates. So he wants rates to come down. And getting back to the original subject, is there going to be a market crash? Well, stocks and shares have moved up to all-time highs since the 90-day delay was put on applying the tariffs. But now stocks and shares are looking fully valued, if anything, looking overvalued. So there will be a pullback for sure. The question is, how big would that pullback be? And will it continue falling? So what would be the typical catalyst that would send markets down? Well, bond yields is a big one. That's a big one. If bond yields were to move up, in other words, bond traders would see that the markets or that bonds are not being sold and that investors and traders are not investing in bonds and see bonds as a higher risk than they should be. In other words, higher risk adding more to the yield or more compensation for taking out those bonds. That could send the markets down. The other things that could send the markets down would be, for example, a trade war where global trade contracts and there's no trade between the necessary countries. That could send markets down. So that's another angle. Another economic number to look at is employment. Now, the non-farm payrolls came out recently last Friday and showed a 73,000 increase in jobs or jobs created. Um, the BLS Bureau of Labor Statistics said that most of those were government jobs in education, which again contradicts what Trump wants, because Trump wants more private sector jobs. However, the numbers were revised downwards for the last 2 months, which lost around about 258,000 jobs were lost. So overall, there's actually only 19,000 jobs have been created, which is a very, very low number. So rising unemployment would be a big problem. Remember, the more people unemployed, the less tax revenue coming in, and the more social security benefits are paid out by the US government. So rising unemployment could be a particular catalyst. Another catalyst could be corporate earnings. If corporate earnings were to fall short of expectations of what Wall Street is expecting, then that also would send down financial markets, because the earnings would not be reflective of the actual share price, and their share prices would have to be realigned, reassessed, and revalued in line with the earnings of these big companies. So that's another factor that could bring down financial markets. Overall, those are the main things. Interest rates and inflation could also push down markets. If inflation rises and interest rates stay high, then the cost of money becomes expensive. Therefore, you've got less liquidity floating around. Less liquidity, that means markets would go down. People would sell the stocks and shares and they'd go into bonds and or release some of the profits that they've made on the stocks and shares. That could also cause a downturn if inflation and interest rates were to stay high. Conversely, how I see it is I think we're going to see a pullback of some sort. Not sure the percentage rise, 5 to 10%, maybe more. Some people are talking about going all the way down to the levels of April 25, which was this year. And then some people are talking about going all the way down to October 23. If it went down to October 23, then you are talking about a 30% pullback. So that would be significant. Overall, on the horizon, I don't see a market crash. I do see a pullback and then a lot of people coming in to buy the dips because overall there's going to be significant liquidity poured into financial markets and into the economy with government borrowing and of course printing of money. And once that printing of money takes real effect, then you're going to have asset price inflation. So you're going to have stocks that are going to go up and you're going to have absolute inflation going up, and that all that money that's being generated will cause a higher demand on goods, and that will push up inflation on the retail side. Conversely, you do have at least 15.5 trillion, even higher, $15.5 trillion of overseas foreign investment into the US, and that will create about a million jobs. That million jobs will create huge amounts of revenue. You have to remember, Scott Bessant and Donald Trump have stated clearly the way to get out of debt is through growth. So by having growth, having higher GDP, they want to make the debt, the loan to GDP ratio lower. So the GDP shoots up to 6% or 7% per annum. And as a result of that, you end up having a loan or debts that are lower than GDP, and that would revalue the bonds upwards. Bonds would go up in value, the yields would come down and make the US economy stronger if they have higher GDP. So Scott Bessant, who's the US Treasury Secretary, said that they want to grow their way out of debt. And that's going to be one of the targets of the US, to continue growing upwards and therefore make the US bonds more valuable and more attractive for investors and traders to take on board. So in summary, is there going to be a market crash? Could be. I can't see it, but some analysts are calling for a complete wipeout of financial markets. That would push gold and silver up dramatically. Bitcoin would fall to about $80,000 a coin if there was a 20-30% drop in financial markets. Very interesting one to watch, obviously, to keep your um, ear to the floor and keep your eyes open. If you want to join the mentorship program, then you can DM me direct. This is Mayor Valensky with Driving Markets, your weekly podcast. Catch you later.